Accounting process. How one transaction converts into financial statements. Let's learn this with some examples. Rahul, who is the owner of CB Smart Mart, sold goods worth rupees 25,000 for cash. Will this directly appear in the balance sheet? Answer is no. It has to be recorded. Then, to reach a profit and loss account, there must be a certain process, right? That needs to be followed. Again, take one example. Imagine one day 85 transactions like purchases, salary, rent, sales, deposits, furniture, electricity, etc. came with you. And in 1 year, you have 30,000 plus transactions. Can you remember those transactions? Again, the answer is impossible. So for all these things, what do we need? We need a systematic process, accounting process. Okay. Now what is accounting process? Definition: sequence of activities. Identify, record, classify, summarize, analyze, interpret, and communicate. Simple meaning: journey from transaction to a useful information. Okay. Now why do we need it? Let's take real-time example. Think you are ordering food online. You place the order. The restaurant accepts it. The food is prepared. It is packed. Finally, it is delivered to your doorsteps. Now each step follows a proper sequence. If the restaurant skipped steps or makes them up, your order would be a mess. Similarly, accounting follows a sequence to ensure accuracy and reliability. Okay, so what is the key point? Accounting follows a sequence.